Most traders believe the market is where money is made. That belief is the first mistake. Money is not made in the market. Money is kept through risk management. The market is simply a mechanism, a machine that transfers capital from the undisciplined to the disciplined. And the only thing standing between you and becoming part of the losing majority is how you relate to risk. Before you ever talk about entries, liquidity, or timing, you must understand this. Every trade you place is a business decision under uncertainty. And uncertainty does not reward hope. It rewards structure. This is where the first law of risk management lives, even though most traders never recognize it as a law. The first law is simple, but brutal in its honesty. You are not paid for being right. You are paid for managing downside. Most traders build their identity around prediction. They want to call tops. They want to catch bottoms. They want the ego satisfaction of being right while the market moves. But the market does not pay for accuracy. It pays for survival. A trader who is right 40% of the time can outperform a trader who is right 70% of the time. If the first trader understands risk and the second does not, this is not theory, this is fact. And once you accept this, your entire relationship with trading changes. Risk management is not a defensive tool. It is an offensive weapon. It determines how long you stay in the game. And staying in the game is the only edge that compounds. This leads us into the second law, which most traders hear but never internalize. Risk must be predefined before the trade exists. If you do not know how much you are willing to lose before you enter, you are not trading. You are gambling with a chart on the screen. Professional traders define risk first, then look for opportunity. Retail traders look for opportunity first, then emotionally negotiate risk after entry. That difference alone separates amateurs from professionals. When risk is not defined, emotions fill the gap. Fear begins to whisper, hope begins to argue, and discipline quietly leaves the room. The market does not care about your emotions, but it will exploit them relentlessly. Predefined risk does something powerful to the mind. It removes surprise. And surprise is what destroys traders. Not losses. Losses are normal. Unexpected losses are what cause emotional damage. When you know the worst case scenario before entry, your nervous system remains calm. You are no longer reacting. You are executing. And execution is everything. Now understand this carefully. Risk is not defined by lot size alone. Risk is defined by the distance between entry and invalidation. Your stop loss is not a random number. It is the price level that proves your idea wrong. When that level is violated, the trade is no longer valid. Staying in after that point is no longer trading. It is denial, which brings us to the third law. A stop loss is not protection. It is an admission of uncertainty. This is where ego gets involved. Many traders avoid stop losses because they believe it means they are weak or unsure or lacking confidence. In reality, the opposite is true. The most confident traders are the ones who accept that they can be wrong at any time. Confidence is not believing you are right. Confidence is knowing you will survive if you are wrong. The stop loss is not there to save money. It is there to save your mindset, because once your mindset breaks, your strategy no longer matters. A trader without a stop loss is a trader who believes the market owes them something, and the market punishes entitlement faster than ignorance. Losses taken correctly do not hurt. Losses avoided incorrectly destroy accounts. Now, let's talk about the fourth law, one that most traders violate daily without realizing it. Risk must be consistent across trades. This is where discipline shows up, not in your entries, not in your analysis, but in how you size your exposure. When you increase risk emotionally and decrease risk fearfully, you are no longer following a system. You are following your mood, and moods do not compound. Consistency in risk creates consistency in results. Not wins, results. Professional traders think in series, not individual outcomes. One trade means nothing. 10 trades mean very little. 100 trades begin to reveal truth, but that truth can only be measured if risk is constant. If one loss costs you 1% and another costs you 7%, your data becomes useless. Your performance becomes distorted. You begin blaming the market when the real issue is inconsistency. Risk consistency allows probability to work in your favor. Without it, probability becomes noise. This leads naturally into the fifth law. which is uncomfortable for many traders to hear. Your account size determines your strategy, not your ambition. Many traders attempt to trade a large account strategy with a small account. They want big returns without respecting mathematical reality. This is not confidence. This is impatience disguised as belief. Every account size has a ceiling of safe aggression. Exceed that ceiling, and you introduce volatility into your equity curve that has nothing to do with the market and everything to do with your psychology. When drawdowns become emotionally painful, discipline collapses. You hesitate. You revenge trade. You deviate. And the system you trusted suddenly feels broken. It was never broken. Your risk was a trader who respects their account size, trades smaller than their ego wants to, and that restraint is what allows growth. The market rewards patience with opportunity. It punishes impatience with lessons. And here is the final law we will cover in this chapter, one that quietly governs all others. Risk management is a daily habit, not a rule you remember under pressure. Under stress, you do not rise to your strategy. You fall to your habits. If you only think about risk when you are about to enter a trade, it is already too late. Risk management is decided before the trading session begins. It is embedded into your routine, your position sizing, your journal, your expectations. Professional traders are boring. They do the same thing every day, same risk, same execution, same process. The excitement that retail traders chase is the very thing professionals avoid, because excitement is emotional volatility, and emotional volatility leads to financial volatility. Risk management is not exciting. It is repetitive. It is disciplined. It is unemotional, and that is why it works. This chapter should leave you with one uncomfortable realization. If you are losing money consistently, it is not because you lack entries. It is because you lack respect for risk. Fix that, and everything else becomes easier to see. Most traders are not defeated by a single bad trade. They are defeated by a sequence they were never prepared for. This chapter is where illusions die, because here we confront the mathematics of risk, not the fantasy of outcomes. The market moves in probabilities, not promises. And probabilities express themselves through distribution, not fairness. Wins and losses do not alternate neatly. They cluster, they streak. They arrive in patterns that test emotional control. If you do not understand this, you will always misinterpret what is happening to you. This leads us to the seventh law of risk management. Drawdowns are not a failure. They are a feature. Most traders treat drawdowns as evidence that something is wrong. That mindset alone destroys them. Because once you believe drawdowns should not exist, you will constantly interfere with your system to avoid them. But every profitable system has drawdowns. Every single one. The difference between professionals and amateurs is not whether they experience drawdowns. It is whether they planned for them. A drawdown is simply the cost of doing business in probabilistic environments. It is the rent you pay to remain in the market. When you design risk incorrectly, drawdowns become emotionally intolerable. When you design risk correctly, drawdowns become boring. And boredom is where consistency lives. Here is the truth most traders never accept. You are not trading to win today. You are trading to survive a series. A single trade outcome means nothing. 5 trades mean very little. But 100 trades executed with consistent risk begin to express expectancy, which brings us to the 8th law. Expectancy matters more than win rate. This is where beginners get trapped. They chase high win rates because it feels safe. It feels controlled. But a high win rate with poor risk reward is a ticking time bomb. You can win 7 trades in a row and lose everything on the 8th if your risk is undefined. Expectancy is the mathematical expression of your edge. It answers one question only. Over time, does this behavior produce positive results? Expectancy does not care about emotions. It does not care about confidence. It does not care about how you feel today. It only cares about 3 variables: how much you risk, how much you make when right, and how often you are right. Most traders obsess over frequency. Professionals obsess over magnitude. A trader with a 40% win rate and strong risk reward can outperform a trader with a 70% win rate and weak structure, but only if risk is controlled. Without risk management, expectancy collapses. This leads us into the 9th law. which is subtle but lethal when ignored. Winning streaks are more dangerous than losing streaks. Losing streaks create fear. Winning streaks create overconfidence. Fear makes you hesitant. Overconfidence makes you reckless. Most traders blow their accounts after a period of success, not failure, because success convinces them they have figured it out. And once that belief forms, discipline erodes. They increase position size. They loosen stops. They take marginal setups, all under the illusion of growth. But growth that is not earned through discipline is borrowed from the future. And the market always collects. Risk management must not change based on recent outcomes. Your best week should be traded exactly like your worst week. When you feel invincible, that is when your rules matter most. Now let's talk about the 10th law, one that ties everything together. Risk must be measured in percentages, not money. Money triggers emotion. Percentages maintain objectivity. When you think in currency, you attach meaning to outcomes. When you think in percentages, you think in process. Professionals never ask, how much money can I make today? They ask, how much am I willing to risk per idea? This shifts the focus from outcome to execution. A 1% loss is the same regardless of account size. It keeps the game fair, it keeps the math intact, and most importantly, it keeps your psychology stable. When risk is controlled, time becomes your ally. Compounding begins quietly, equity curves smooth out, and decisions become easier. But when risk is inconsistent, everything becomes reactive. Now understand this deeply. Risk management does not eliminate losses. It eliminates ruin. You will still lose trades. You will still have drawdowns. You will still feel discomfort, but you will remain functional. And functionality is what allows learning. A trader who survives learns. A trader who blows up only repeats. This chapter should leave you with a new respect for restraint, because restraint is not weakness. It is mastery delayed. Most traders believe risk is only numbers, lot size, stop distance, percentage exposure. That belief is incomplete. The most dangerous risk in trading cannot be measured on a chart or calculated in a position size calculator. It lives in the mind. And because it is invisible, it is rarely respected. This chapter is about emotional risk, the kind that ruins execution, distorts perception, and causes traders with solid models to behave like beginners. You can have perfect analysis and still lose money consistently if emotional risk is unmanaged. The market does not beat most traders. They beat themselves in moments of pressure. Emotional risk shows up in very specific ways, not randomly, not mysteriously. It appears when expectations collide with reality. This leads us to the 11th law. Expectation is a form of risk. The moment you expect a trade to work, you are emotionally invested. An emotional investment changes behavior. You manage trades differently when you expect to win. You hesitate to take stops. You move targets prematurely. You interfere. Expectation creates attachment. Attachment creates distortion. Professional traders have intent, not expectation. They intend to execute a model. They intend to manage risk. They intend to follow rules. They do not expect outcomes. Expectation says, this should work. And so intent says, I will execute regardless. That difference determines survival. Now understand this. Hope is not neutral. Hope is risk. Hope keeps traders in losing trades longer than logic allows. Hope whispers that price will come back. Hope reframes invalidation as temporary discomfort. But the market does not respond to hope. It responds to liquidity and order flow. Once a level is invalidated, staying in is no longer trading. It is bargaining with randomness. This leads directly into the 12th law. A losing trade managed well is a success. Most traders cannot accept this. Their identity is tied to winning. And because of that, they never develop emotional maturity. A well-managed loss protects capital and confidence. A poorly managed win damages discipline. Over time, discipline matters more. Professional traders review losses differently than amateurs. They do not ask, why did this lose? They ask, did I execute correctly? If the answer is yes, The trade was successful regardless of outcome. This reframing is critical because if you only feel successful when you win, you will always chase validation. And validation is emotional leverage the market uses against you. Now let's talk about execution risk, which is where emotional risk expresses itself. And this brings us to the 13th law. Execution errors compound faster than market losses. Missing entries, chasing price, closing trades early, hesitating on valid setups. These are not small mistakes. They are structural leaks. One execution error rarely hurts. Repeated execution errors quietly destroy expectancy. Most execution errors come from fear of loss or fear of missing out. Both are emotional states. Both are forms of unmanaged risk. When fear dominates, you underperform your system. When greed dominates, you overexpose. The solution is not more analysis. It is tighter emotional structure. This is why professionals trade fewer setups than they could. They do not maximize opportunity. They maximize clarity. Clarity reduces emotional noise. Noise increases risk. Which brings us to the 14th law. Overtrading is emotional risk disguised as productivity. Many traders believe more trades equal more money. In reality, more trades often equal more emotional fatigue. Fatigue leads to shortcuts. Shortcuts lead to mistakes. Mistakes lead to drawdowns that feel unfair. Overtrading usually comes from one of two places: boredom or desperation. Neither belongs in trading. Trading is not entertainment. It is execution under constraint. If you need excitement, the market will happily provide expensive lessons. Now let's address the most dangerous emotional pattern of all, which leads us to the 15th law. Revenge trading is a risk management failure, not a psychological flaw. Revenge trading happens when loss exceeds emotional tolerance. That means risk was too large relative to psychological capacity. This is not a character problem. It is a design problem. If one loss makes you want to get it back, your risk was too high, period. Risk must be small enough that losses are emotionally absorbable. When losses are absorbable, you remain rational. When they are not, you become reactive. Professional traders design risk to protect emotional capital as much as financial capital, because once emotional capital is gone, logic cannot function. This chapter should leave you with one realization. If you cannot execute your plan during stress, your risk is too large. Reduce risk until execution becomes boring. That boredom is the foundation of consistency. By now, you understand the essential truths. Risk is real. Losses are inevitable. Emotions are lethal. But understanding alone is insufficient. Knowledge without application is a debt that compounds with interest. This chapter is about structure, about building a risk framework that allows survival, growth, and compounding edge. The 16th law of risk management is foundational. Frameworks are superior to rules. Most traders operate under rules. Never risk more than 2% or always set stops. Rules are rigid, reactive, and often abandoned under pressure. A framework is different. A framework encompasses process, mindset, and mathematics. It tells you not just what to do, but why, when, and how. It allows adaptation without compromising integrity. Your framework is your map in a probabilistic world. Without it, you wander. With it, you navigate. At the core of a framework lies position sizing, which is governed by the 17th law. Risk per trade is a percentage of equity, not ego. We discussed percentage risk in Chapter 2, but now it must be contextualized within a framework. Position sizing should never be arbitrary or influenced by recent wins or losses. Each trade is a calculated exposure. Each exposure preserves your ability to trade tomorrow. That is the first priority. Growth is secondary. This is where most traders fail. They confuse ambition with capacity. They risk too much, too soon, thinking their skill justifies aggression. Skill without risk control is a formula for rapid failure. The 18th law addresses the invisible force behind these failures. Market conditions change, but risk tolerance must not fluctuate with emotion. Traders often increase risk in hot markets or reduce it in boring markets. Both approaches are traps. The market does not owe consistency. You must create consistency within yourself. Your framework should dictate maximum allowable risk per trade based on account size, regardless of market excitement. Emotional interference is not optional. It is a design flaw to be removed. Now we arrive at the 19th law, which binds all the prior principles together. Journaling and reflection are the ultimate risk control tools. A framework without feedback is blind. Most traders fail, not because of the market, but because they cannot recognize patterns in their own behavior. Track every trade, entry, exit, position size, psychological state, rationale, and outcome. Analyze not only what happened, but why you felt and acted the way you did. This practice reveals emotional risk, execution errors, and deviations from process that might otherwise remain invisible. The insights gained are more valuable than any single technical indicator. Next is the 20th and final law. Survival is the ultimate compounding strategy. All the previous laws converge to this point. If you remain in the market, you have a chance to compound skill and capital. If you do not, nothing else matters. Patience is not passive. It is proactive risk management. Boredom is not weakness. It is consistency in action. Losses are not punishment. They are tuition in the school of probability. This law is both simple and profound. Protect your capital. Protect your mind. Execute your process consistently. The market will reward time and discipline more than intuition or prediction ever will. Now, let's combine all 20 laws into practical application. Predefine risk before every trade. Accept losses as part of the process. Keep risk consistent relative to equity. Avoid overtrading. Treat drawdowns as neutral events, not catastrophes. Measure risk in percentages, not currency. Maintain emotional discipline above all. Journal every trade to monitor both behavior and outcome. Understand that expectancy, not win rate,